Hey everyone, welcome back. Today we're diving into something pretty special.
Oh, yeah.
Warren Buffett's letter to Berkshire Hathaway shareholders from 1985.
I've heard good things.
It's fascinating stuff, even if you aren't like a Buffett fanatic.
Right.
There's gold in here for any investor, really.
What kind of goals are we talking?
Well, 1985 was a wild year for Berkshire. Returns went through the roof.
How wild.
But even then, Buffett's waving a little red flag saying, "Hold on, folks, this party can't last forever."
Always the voice of reason, huh?
Oh, and get this, they were shutting down their textile business.
Did not know they were in textiles.
Right. And his take on executive pay. Whole different ballgame.
Okay, I'm intrigued. Let's dive in.
So picture it, 1985, market's on fire, everyone's making money hand over fist.
Good time.
Berkshire's net worth up a mind-blowing 48%.
Seriously.
No joke. Their per-share book value went from about $20 to over $1,600 in just 21 years.
That's got to be some kind of record.
Compounded annual growth rate of 23.2%. But there's Buffett saying, "Don't get used to this, folks."
Why is that? What's he seeing that others aren't?
Well, he basically says the game's changed. Finding those undervalued companies, those bargains he loves, it's not as easy anymore.
Makes sense, I guess.
Plus, think about it, Berkshire's gotten so big.
Yeah, they must have so much cash to invest.
Exactly. Finding enough high-return investments for all that money, it's a whole new challenge.
So almost a victim of their own success in a way.
Kinda, yeah. Most companies would just keep chasing growth no matter what.
Right, bigger is better, that whole thing.
But not Buffett. He's like, just earning more because you're investing more. That's not impressive.
It's like, what are you actually doing with the money?
Right. He compares it to bragging about having a bigger savings account.
Huh. True.
It's not about the size, it's about what you do with it.
Reminds me of my grandpa. He always said, knowing where the fish are is more important than having the biggest net.
Love it. And speaking of knowing where the fish are, Buffett, he had this knack for picking winners.
Late.
Nebraska, Furniture Mart, See's Candies, Buffalo Evening News. These three were absolute powerhouses for Berkshire.
What were they doing right?
Over 15 years, their pre-tax earnings went from $8 million to $72 million.
Wow, that's incredible growth.
And the kicker, they didn't need much extra capital to do it.
So efficient, too. That's got to be the economic goodwill Buffett talks about so much.
Exactly.
Yeah.
They didn't have to keep pouring money back in just to grow earnings. They were cash machines.
That's especially valuable during inflation. Right?
Oh, absolutely. And you want to talk about impressive. Rose Blumkin, the chairwoman of Nebraska Furniture Mart.
Yeah, I've heard of her. Tough lady.
Tough. She was 92 years old and still working 7 days a week.
That's dedication, respect.
If you're ever in Omaha, you gotta visit that store. It's a legend.
On my list.
But it wasn't all sunshine and roses. See's Candies and the Buffalo News were facing some tough times.
What was going on?
Sales were down, competition was heating up, the usual suspects.
Ah, so even Buffett's picks weren't immune to challenges.
Right, but here's the thing. All three businesses, they had incredible leadership.
People who knew what they were doing.
Exactly, and that brings us to a really interesting point. How Buffett rewards those managers.
Yeah, how does he?
Forget about stock options. He's not a fan.
Really? Why not? They seem pretty standard.
Well, he argues they often reward managers just for holding on to earnings.
Not for, actually doing anything impressive.
Right. It's like, oh, your savings account balance went up. Here's a bonus.
Doesn't make much sense when you put it like that.
And he points out this hilarious hypocrisy. Companies complain when stock prices are low because they're vulnerable to takeovers.
Right, yeah.
But then they happily use those same low prices for employee stock options.
Kind of ironic, huh?
Total double standard. But Buffett's not just complaining. He actually offers some ideas for making stock options, more sensible.
If companies insist on using them.
Exactly. He says, tie them to real responsibility.
So, managers who actually have a big impact.
Right. Factor in the cost of those retained earnings and make sure the option price reflects the true value of the business.
Makes sense.
Now, he does admit some great managers use options well, create a real ownership culture.
Yeah, I can see that.
But Berkshire, they do things differently.
How so?
Bonuses tied directly to the performance of each business unit.
Not the overall stock price.
Nope. And those bonuses, they can be huge potentially millions of dollars.
Wow, that's a lot of motivation.
So even the head of a smaller unit can out-earn someone running a bigger one if their performance is better.
It's all about results, not just size.
Exactly. Okay, now let's switch gears a bit. Insurance industry, 1985 was a weird year.
Okay.
Premiums were sky high. But so were losses, social inflation, all those massive lawsuits. It was a headache.
I bet the insurance business is tricky.
It's kind of like a commodity business. Profits depend on the supply and demand of capacity.
Capacity, meaning...
Basically, how much risk insurers are willing to take on.
Ah, got it.
Now, here's the crazy part. Unlike building a steel mill, capacity in insurance, you can increase it instantly.
Just like that. How?
By raising more capital. And guess what? Everyone was doing it.
Oh boy, not good.
Buffett's like, this is going to lead to price wars and lower profits.
Classic oversupply problem.
He even has this brilliant analogy, the except for insurance company.
That sounds fun. What is it?
It's a way of saying, hey, managers, you got to own all your decisions, not just the good ones.
No cherry picking.
And guess what? This actually happened in Berkshire's reinsurance business. They're not afraid to admit when they mess up.
Shows humility. I like that.
So back to this reinsurance thing. Here's where Berkshire had a big advantage. They weren't heavily reliant on it.
So they could do things others couldn't.
Yep. They could write huge policies that other insurers just couldn't handle.
How come?
Think of it like this. Most insurers, they keep a tiny net line of risk on big policies.
And they pass the rest on.
To reinsurers. But
Yeah.
reinsurers were getting scared in '85.
Why? What happened?
All those unpredictable, massive lawsuits, they'd been burned, so they were pulling back.
So Berkshire steps in to fill the gap.
Exactly. Opportunity knocks. They ran an ad for their national indemnity company, specifically for policies over $1 million.
Bold move.
Got over 600 replies.
Wow. People were clearly looking for someone who could take on that kind of risk.
Right, and that's what happens when you have the financial muscle and you're not afraid to use it.
That's the Buffett way.
Now, besides insurance, Buffett also dipped his toes into arbitrage.
Arbitrage. That's buying stock in companies being acquired, right?
Exactly. Not his favorite thing, but hey, sometimes you gotta park your cash somewhere.
Makes sense.
Like with Beatrice Companies, basically a temporary home for some of Berkshire's money.
It's a different game than long-term investing, though.
Oh, absolutely. Arbitrage, it's short-term, less predictable.
Not the buy and hold forever approach Buffett loves.
Right. He also talks about two other big holdings in this letter, Washington Public Power Supply System bonds.
Those were a bit controversial, right?
Yeah, there was talk of potential default, but
Yeah.
Buffett, he planned to hold on to them for the long haul.
Betting on a comeback.
Yep. And then there was Capital Cities ABC.
Ah, yes. The media giant.
He bought 3 million shares to help them buy American broadcasting companies. Big move.
Media landscape was changing fast back then.
And here's where things get really interesting. He gave Tom Murphy, the CEO of Cap Cities,
Yeah?
the voting rights for Berkshire's shares.
Whoa, seriously. That's a lot of trust.
Right. Shows how much confidence he had in Murphy's leadership.
And his belief in the long game rather than short-term profits.
Exactly. And to top it off, he tells this funny story in the letter.
Oh, do tell.
He admits he'd actually SLD Cap Cities stock years earlier at a much lower price.
Hoax.
He even jokes that he needs more time to come up with a good excuse.
Even the Oracle of Omaha makes mistakes now and then.
Right. It's a good reminder that we all mess up sometimes. What matters is what we learn from it.
Absolutely.
Yeah.
So what do you think so far? Anything jumping out at you?
Well, it's fascinating how Buffett's already seeing the writing on the wall.
Even though they're killing it.
Yeah, they're riding high, but he knows those easy gains won't last forever.
Market's changing. Berkshire's getting bigger.
He's already thinking about how to adapt. Smart guy.
Yeah. That's what we're still talking about him decades later.
Makes you wonder, though, can his principles work in NY market? Or are they tied to a specific time and place?
That's the million-dollar question, isn't it?
He's thinking ahead, that's for sure.
Always a step ahead of the game.
And it's not just about the market changing, it's Berkshire itself, right? Getting harder to find those hidden gems.
Too big to be nimble, almost.
Right. So what does he do? Starts looking at buying whole companies, not just stocks.
Interesting. Makes sense, though, if you've got that much capital to deploy.
And that's exactly what they did. Right after this letter, they scooped up Scott and Fetzer.
Scott and Fetzer, now that rings a bell. Weren't they kind of a mini conglomerate themselves?
Oh yeah, about $320 million, plus they took on around $90 million in debt.
So not a small purchase.
Right. Not at all. And Scott and Fetzer was like a little Berkshire, you know? 17 different businesses.
What kind of business?
Everything. Kirby vacuum cleaners, Campbell Hausfeld air compressors, Wayne water pumps, you name it.
Wow, a real mixed bag.
But they all had one thing in common. Solid earning power.
Ah, so there's the Buffett logic. Doesn't matter what they make as long as they make money.
Exactly. And it plays into his whole easy-to-understand
But if
philosophy.
it's some complicated tech thing, he's out.
Yep. He wants businesses anyone can grasp. No black boxes.
Smart. Keeps things simple.
And then there was World Book, kind of the crown jewel of Scott and Fetzer.
World Book. The encyclopedia people.
The one and only, made up about 40% of their sales and even more of their profits.
No kidding. I remember those books from when I was a kid. Everyone had them.
They were selling more encyclopedias than their top 4 competitors combined.
Dominating the market. That's got to be a key factor for Buffett.
Oh, absolutely. Market leadership is huge for him. And get this, Buffett himself was a huge World Book fan. Yep, used them for 25 years. His grandkids were using them too.
So he's putting his money where his family's bookshelves are. Like that.
Right. It's not just about the numbers. It's about believing in the product.
Shows he's thinking long-term, too. Encyclopedias, they're not a fad.
Exactly. They're a source of knowledge meant to last.
And speaking of long-term thinking, let's talk about the elephant in the room, the textile business.
Ah, yes, the one that got shut down.
Tough decision, but it shows he's not afraid to cut his losses.
Even on something they had owned for over 20 years.
Sentimentality only goes so far in business, right?
Right. They'd gotten control of Berkshire Hathaway back in '65, and at that time, it was mainly a textile company.
So it was like their legacy business almost.
Yeah, but the thing is, it had been struggling for years.
Yeah.
Even with good management, it just wasn't a consistent earner.
Sounds like a tough industry to be in.
It was. And Buffett admits in the letter that he was slow to see the reality of the situation, kept hoping things would turn around.
Hope springs eternal, right?
But in the end, it was just a money pit. He compares it to being stuck in a leaky boat.
At some point, you got to jump ship and find a new one.
Exactly. Better to move on than keep bailing water.
It's interesting, though, he doesn't blame the workers or even foreign competition for the textile business failing.
No, he's pretty clear about that. Says their labor costs were actually pretty low, even compared to other American textile companies.
But what's the culprit?
The business itself, the fundamentals.
Poor fundamental economics, as he calls it.
Exactly. Some businesses are just set up to struggle no matter how hard you try.
And the auction of their textile equipment? That really drives this point home.
Oh yeah, millions of dollars worth of machinery.
And it's sold for peanuts.
It's like a reminder that tangible assets, they can lose value fast when the business model itself is broken.
Book value doesn't always tell the whole story.
Right. Sometimes those assets are just dead weight.
And it's such a contrast to the value of economic goodwill, as Buffett sees it.
He says the goodwill of a couple of paper routes in Buffalo, or a single See's candy store, worth more than all that textile equipment combined.
That's incredible. It's the power of brands, reputation, customer loyalty, the intangible stuff.
The stuff that drives truly great businesses long term.
Absolutely. So we've got businesses being shut down, assets being sold off. Sounds like a rough year.
You'd think so, right? But remember, they still managed to grow their net worth by 48%.
That's mind-boggling. How?
Smart capital allocation, that's another big theme in this letter.
Always a core principle for Buffett.
He's constantly hammering on the need to use capital wisely, not afraid to sit on cash if he can't find good investments.
And when he does invest, he's looking for that high return on invested capital.
Always. He even criticizes companies that are obsessed with growing earnings without considering how much capital it takes to get that growth.
Right. It's not just about getting bigger. It's about getting bigger efficiently.
He says it's like bragging about a bigger savings account. Meaningless unless you're earning a high interest rate on that money.
Makes sense.
And this ties back to his dislike for stock options, you know?
Yeah, how so?
He argues that they often reward managers just for retaining earnings, not for actually doing anything smart with them.
Just letting the money sit there.
Exactly. He uses this great example. Imagine giving a manager a 10-year option on a savings account.
Okay. Well,
They
look.
get a huge reward just because the account balance grows naturally due to compound interest.
But they didn't actually do anything.
Right. It's a perfect illustration of what's wrong with many corporate compensation plans.
Options should reward real value creation, not just growth fueled by sitting on cash.
Couldn't have said it better myself. Now, Buffett does admit that options can be useful in some cases.
When they align the interests of managers and owners, right?
Exactly. But he believes they should be used carefully and strategically.
So no blank checks.
He outlines 3 key principles for designing effective stock options.
Lay 'em on me.
First, they should be tied to real responsibility.
Meaning.
Managers with a broad scope of authority, not just anyone.
Okay, that makes sense.
Second, they should account for the cost of those retained earnings.
Recognizing that money could be put to better use elsewhere.
Right. And third, the option price needs to be realistic based on the actual value of the business.
So no funny business with artificially low prices.
Exactly. Keep it honest. And he also points out that Berkshire does things differently when it comes to incentivizing their managers.
How so?
They use a system of bonuses based solely on how well each individual business unit performs.
Not Berkshire's overall stock price.
Nope. It's all about what you do, not what the market does.
Creates a more focused environment, I imagine.
Exactly. Managers are focused on maximizing the value of their own businesses, not obsessing over short-term stock fluctuations.
Makes sense. Keeps them grounded in the fundamentals.
And those bonuses, they can be significant. Some managers can earn 5 times their base salary or more.
No kidding. That's a nice incentive.
It's even possible for a smaller unit manager to out-earn someone running a bigger unit if their performance justifies it.
So it's a true meritocracy. Rewards are tied directly to results.
Absolutely. Okay, before we wrap up this part of our deep dive, there's one more interesting story from the letter I gotta share.
Oh, I'm all ears.
Remember how Buffett bought 3 million shares of capital cities to help finance their acquisition of American broadcasting companies?
Yeah, that was a big deal.
Well, it turns out he'd actually sold Berkshire's previous holdings in cap cities a few years earlier.
No way, seriously.
At a much lower price. He even jokes in the letter that he needs more time to come up with a good excuse for what he did.
Huh. Even the best of us make mistakes.
Right. It just goes to show, even the Oracle of Omaha, he's not infallible.
Makes him more human, I guess. And it shows he's got a sense of humor about it.
Exactly. But it also makes you wonder, what did he learn from misjudging cap cities the first time around?
Right. How did that experience shape his decision to buy back into the company later at a much higher price?
That's the million-dollar question.
It gets at the heart of his investing philosophy, doesn't it? Patience, waiting for the right opportunity.
Even if it means missing out on some short-term gains.
He's playing the long game, always.
Like he's saying, don't chase every shiny object. Wait for the deals that truly make sense.
Wise words. And this situation with Cap Cities, it seems to have reinforced his conviction in one of his core beliefs.
Which is?
That it's better to buy a great company at a fair price than a fair company at a great price.
Ah, another one of those classic Buffett quotes. He'd rather pay a bit more for something truly exceptional
Than try to bargain hunt for mediocre stuff.
Makes you think about your own investment strategy, doesn't it?
It's all about quality over a quick buck.
He's in it for the long haul, that's for sure.
And it paid off. Big-time Cap Cities turned into a home run for Berkshire.
Makes you realize this guy, he's thinking on a different level. You know, reading this letter, it really gets you inside his head.
Yeah, I'll say.
He's making these incredible returns, but at the same time, he's already starting to question some of the, accepted wisdom about the stock market.
What do you mean?
Well, he was a big believer in the ideas of Benjamin Graham, right?
Oh, yeah, the father of value investing.
But even back then, in '85, Buffett's seeing that the market, it doesn't always behave rationally.
People get emotional, they panic, they get greedy. It's not always about logic.
Exactly. He tells this funny story in the letter about an oil prospector who dies and goes to heaven.
Okay, I'm listening.
So he's up there, sees St. Peter, and shouts, "Oil discovered in hell."
That's a good one.
Great. And suddenly all the oilmen in heaven, they're rushing to get back down to hell.
Can't miss out on the action.
The prospector, he hesitates for a second, then says, well, I guess I'll go with the rest of the boys. There might be some truth to that rumor after all.
Classic herd mentality. Fear of missing out.
It's a perfect illustration of how fear and greed, they can drive these crazy market swings.
It makes you wonder how much of it is actually based on solid analysis.
Right. But even though Buffett's becoming skeptical of this whole efficient market idea.
The idea that stock prices always reflect all available information.
Exactly. He still believes in the power of long-term investing.
So what's his view then? If it's not all efficient and perfect?
He sees the market as a weighing machine in the long run.
Meaning?
Eventually, it'll reflect the true value of businesses.
So the key is to find those undervalued businesses before the market catches on.
Exactly. And that's why he always stresses focusing on the fundamentals of a company, not just the stock price.
Looking for those strong competitive advantages, solid management, consistent profits.
The stuff that really matters long term.
It's easy to get distracted by the day-to-day noise, though.
Oh, for sure.
Yeah.
So if we try to bring all this back to today, what can we as investors learn from this letter from 1985?
It's full of timeless wisdom, that's for sure. For me, the biggest takeaway is the importance of thinking long-term.
Playing the long game.
Exactly. Be patient, focus on a company's intrinsic value, don't get caught up in the daily ups and downs.
It's about finding those compounders, the companies that can just keep growing their earnings year after year.
Generating wealth over time, steadily.
Another big one, capital allocation. Whether you're running a company or managing your own portfolio.
Got to be smart about how you use your resources. Can't just chase growth for its own sake.
Focus on getting those high returns on the capital you invest. And don't be afraid to hold on to cash if you can't find any good opportunities.
Sometimes the best move is to do nothing.
Harder than it sounds, though.
It is. But this letter also shows us something else. Even the greatest investors, they're not always right.
Everyone makes mistakes.
The key is to learn from them, adapt to changing conditions, and never stop learning.
Buffett's a master of that, evolving his approach while staying true to his core principles.
He's always reading, thinking, refining his philosophy, never satisfied.
And he's not afraid to admit when he's messed up.
That's a rare quality, especially among successful investors.
It's inspiring, really. So as we wrap up this deep dive into Buffett's 1985 letter,
It's amazing how relevant his ideas still are today.
it really is, packed with insights for investors of all levels.
Whether you're a seasoned pro or just starting out, there's something in here for everyone.
And here's a final thought to leave you with. Think about Buffett's ability to adapt. Can his principles work in ANY market?
Or are they specific to certain times? What do you think?
We'd love to hear your take. Share your thoughts with us on social media or drop us a line on our website.
We always appreciate hearing from you.
Until next time, happy investing.